Today is a very critical juncture when it comes to international trade, globally speaking. And of course, India is no exception in this. And I want to talk about the various scenarios that are changing and what does it what are the different strategies and uh, policies and both at government level and industry level that need to be done to tackle all these challenges and tap into all the opportunities. So it's not all negative. We have also a lot of positives. So the trade shift that we see today is mainly you can classify that into two different broad areas. One is this geopolitical realignments, where over I would say since 1940s we had this GATT, General Agreement on Trade and Tariff. So that had reduced tariffs multilaterally. All the countries reduced tariffs, barring agricultural sectors where the progress was slow. All the other sectors, we have reduced tariffs globally. So this has actually helped India a lot to become an important player in many of the industries globally in terms of exporting. And exports also have helped the domestic industry to evolve, adopt the global standards, and so on. But in the last few years, there have been changes. So the multilateral trading system, which India has always supported, transparent, rules-based, trading, multilateral trading system, it has been eroded. The WTO has been eroded in the last few years because many countries are going into bilateral, plurilateral kind of trade deals, and India for a long time stuck to the multilateralism. But in the last few years, we also have started going in that direction because it's unavoidable, given that many other countries are doing it. Secondly, also the tariffs are being increased after many decades. So consistently for the last 70 years or so, the tariffs have been going down. But in the last 5 to 10 years, the tariffs are back in the game. It all started with Brexit when UK came out of EU. That kind of signaled the return of protectionism. And then the US, of course, under the Trump administration, both 1.0 and 2.0, in different degrees, have resulted in increase in tariffs, increase in restrictions, protectionism, and so on. So when these things are happening, one I was talking to a friend who is who is into another large tech companies. Um, like a few years ago, there was a there was a casual way of talking about the globalization paradigm in saying that you can make anything anywhere, right? So which means that you don't have to produce in the US to address the US market. You don't have to produce in India to address Indian market, and so on. So basically, the globalized world means that you can produce anything, anywhere, and then supply it to anywhere else, export it anywhere else, right? So that led to this global production networks, where there was a famous analogy or discussion about how a shirt is made in 60, 70 countries and so on, right? With the different parts coming from different places. So now all these things are changing from anything anywhere to everything everywhere. So if you are an exporter, if you are a producer, you may have to consider setting up your shops in every country, because every country is going to come up with requirements that if you export, you have to pay tariffs, and we may you may not be a preferred supplier. We'll go for local suppliers as preferred suppliers. So this is happening across the governments and also across the private sectors that are following what the government is saying. So basically, the move from making anything anywhere to making everything everywhere, which is essentially going to increase the costs, increase the inefficiencies, and so on. So that is the first part, the geopolitical realignments. The second part is regulatory paradigms. So although this looks very wordy and conceptual, you can think of this geopolitical realignments as tariffs by Trump administration. That is broadly, that's a big story here. When it comes to evolving regulatory paradigms, you are mainly thinking of the EU coming in with a lot of regulations. And that EU being a master of regulations, that has percolated, whatever they have started, that has percolated into all the trade agreements. So wherever we sign an FTA, free trade agreement, we obviously get a lot of benefits from that. We are getting access to those markets and so on. But we are also getting into this compliance challenges. We have to have this localized compliance in order to be able to supply to these countries. So now let's come to our sector. Uh, in this home products and cleaning supply sector, the uh, there has been a lot of dependence on imports. So we have complex trade networks, which means that uh, we are sourcing raw materials from different countries. We have different surfactant structures we are getting from various countries. And then there are some critical personal care compounds, which is again, imported from other countries. So this is one part. We are dependent on imports, which means that we have to ensure that the ongoing, the war, which I'll talk about later, that shouldn't affect our raw material supply, which of course it's getting affected. But how do we deal with this? Like what kind of resilience strategy should we follow? Second thing is regulatory standards, fast evolving quality benchmarks. These demand that you have to strictly adhere to the domestic and export testing frameworks. So all these regulatory standards coming both domestically and also with all these trade agreements and so on. And third aspect is I've been while being at NITI and also even now with closely working with the government on all these free trade agreements that we have been concluding. So it has been an honor for me to be part of this. So these trade agreements, we have been very conscious of the need for opening up our markets, the Indian industries markets in the importers, in the partner countries, and at the same time opening up imports from those countries to India only when they're absolutely needed. Like the some of these things, this raw materials. On raw materials, we are reducing tariffs, but on the finished products, we don't want to import cleaning products, home and personal care products from other countries. But we for that we can keep the tariffs high. But for the components, the we can keep the tariffs low. So when you talk about free trade agreements, there are, in my opinion, there are at least four different pillars that you have to think about. The first thing is you have to map the tariff structural reforms for raw cosmetics material imports. So because of the trade agreements, I haven't looked into the details, but I'm happy to do that. If some of you are interested in the future, we can do a detailed analysis to see which are the raw cosmetics materials for which the tariffs have been reduced in some of the partner countries, some of the FTA partner countries. So we can re examine like from where should we import products from, inputs from. Second pillar is harmonizing regulatory frameworks with EU and emerging global benchmarks. So we recently concluded the India EU FTA. So there we are, uh, in the process of concluding this investment protection agreement, which is basically a protection for the EU investments coming into India. But we also have to, uh, work further on the regulatory harmonization, things like mutual. um recognition of standards and so on. So, and then we also have to think about other global benchmarks. So we also signed an FTA with UK, with Australia, with New Zealand, EFTA, so many other countries. So all these are coming up with regulatory frameworks that we have to harmonize. Pillar three is how do we make sure that our exports are streamlined in terms of all the clearance and so on. So how do we do that? So there, of course, I've been talking about importing inputs and exporting finished products, but we could also potentially export inputs as well. Although, as an economist, as a trade economist, I always think of adding value. So we don't want to just export inputs, but we should export finished products. But I know there can be operational compulsions where we are better off selling inputs, and we can also do that. So for all these things, we have to understand the clearance rules. Pillar four is setting up domestic chemical manufacturing capabilities that are high yield and scaled up. So that is another thing because we are getting all this demand from the partner countries because of the free trade agreements, reduced tariffs. How about expanding your supply? So, from an analysis point of view, we have to look at supply vulnerabilities. We have to optimize import strategies for essential chemical inputs, specialty chemical inputs. So that is a supply integrity part. Then we also have to think about standards matching. So one thing I've seen is one of my friends is Mr. Atul Jori, who was previously in a leadership position with BIS, and he's a great collaborator when it comes to standards. One of the points he has raised in the past is that we like the domestic regulations or standards that we come up with, like for example, zero defects. These kind of things are great to motivate the domestic industry to reach a higher level of standards, but at the same time, they are not mapped to the global regulations. Like if you take auto industry, we have this Bharat series of norms which are mapped to the Euro series, right? So in a similar way, we have to come up with domestic standards which are mapped with global. So basically, we need this cross-border regulatory integration. So here we have to navigate through the global non-tariff parameters. So other countries, particularly the developed countries, they try to restrict imports, particularly from India, using all these non-tariff parameters. So how do we say that the regulation that we have in India is kind of equivalent to the regulations they have? So this is something we have to do some kind of matching of standards. The third aspect is export optimization. So how do we identify the regional corridors to boost Indian brands in international spaces? So now, of course, we are faced with two. I mean, I was primarily focusing on the benefits coming from free trade agreements, but now let's face the reality. So we have this Middle East war shock, which is hugely, affecting our energy supplies, as increase in energy prices, and also one thing we are forgetting is the exports to Middle East. Also, Middle East has been one of our important trade partners, so that's also affected. And the second aspect is obviously the U.S. tariff regime. Of course, we have a interim deal, and which is still, it has been reduced to 18%, and still there are backs and forths going on. But definitely, U.S. protectionism is an important thing. So let me spend a couple of minutes on the Middle East war. So the feedstock shortages, the paralysis on logistics, the rising input surcharges, and so on. So now chemical bottlenecks, right? So we have almost 90% exposure to Hormuz for methanol imports, and this is a huge, um disadvantage or over dependence in this road. So after this blockade started, our access to these vital raw petrochemical supplies has been severely constrained. The second thing is, yeah, so basically the ethylene glycol. So that's another important aspect where it's 100% it's imported from this region. All these are, as you all very well know, essential components going into like essential solvent. Ethylene glycol is essential solvent for soaps, detergents, and even premium cosmetics. So this is a big vulnerability. So now let's look at what are the different aspects, the disruption axis. What is a particular disruption? What is the impact? Looking at the latest data available, like April 2026. Of course, May and June we still have to wait for more stable data to come in, but and then we can look at the direct effect on the industry. So crude oil pricing, $120 per barrel uh, and above. So that is basically increasing the prices of all these chemical precursors, naphtha, ethylene, benzene, and that is directly affecting the production costs for surfactant particularly, and it's also increasing the packaging polymer prices by at least 8%. Domestic energy is another thing. So natural gas supply reductions in Gujarat and also in other states, these have forced localized production shutdowns, and that means stalled operations at key domestic detergents base units. The third aspect is transit rerouting. So, of course, we have been using the Cape of Good Hope across the African continent, and that is adding 25 to 30 days of additional ocean transit. So, this leads to severe delays in delivery of finished formulations. So the last but not the least, the ocean freight taxes. So freight taxes have doubled. Carrier surcharges jumped between 3,500 and 8,000 per dollars per carrier per container. And I'm not even talking about the insurance. The insurance premium also has increased a lot. So all these things are going to undermine the pricing of low margin bulk exports, particularly detergents. So now let's come to the last aspect, the tariff tightrope. How do you walk this tightrope? The strategic reciprocity and the evolving international sourcing realities. Now you see that you can, like as an eternal optimist, I can say that yes, it's bad. The situation is volatile. It's difficult, but at the same time, let's let's recognize the fact that the peace deal makes us way better than China. 54% is China's duty faced in the US. Vietnam is facing 20% while we are facing 18%. So it's not too bad. But then there are several specific granular details that we are missing here, right? Like one example is 126% preliminary countervailing duties on solar imports in the US. So it's still definitely active. And we also very recently we saw this additional that tariffs that have been imposed. I think for India it was like 12.5% more, and for others it is lower, and so on. So a lot of backs and forths there. But at the same time, the sourcing, the because of tariffs, there is a lot of movement towards Ho Chi Minh City, Vietnam region. So Vietnam is negotiating really, aggressively to get this Annex 3 status, to get 0% import duties with the US. So if Vietnam succeeds, then our 18% tariff becomes a huge trade liability, because as you saw in the previous slide, so they have 20% and we have 18%, which gives us a small edge over them. But now imagine this going to 0%, this staying at 18%. It will be a huge difficulty for us. And the last thing is massive US retail clients. They may rapidly pivot sourcing of cleaning and home care brands from Mumbai. So that is one possibility. Now, how to respond to this? I'm thinking of three different kind of responses we'll discuss. So the first thing is luxury reciprocity. So if we have 0% tariffs on US niche luxury goods like spirits, premium electric vehicles, cosmetics, and so on, for reciprocal 0% access for Indian exports. So this is something we could do, and as you know, the current negotiation is going on, India-US trade deal, and so these are all pointers going in there. Second thing is mass market insulation. So the US giants like Estee Lauder, they already make 95% of market products within India. So to keep the domestic producers safe from these 0% cuts. So that is another thing. So this is what we call as this tariff jumping investments. When the tariffs are high, the investments come into the country, and this is what Trump administration is also trying. The last aspect is has been talked a lot about, but I don't think we have made a lot of progress, and that is Ayurvedic mode. So cultural authenticity will act as an entry barrier because we have a unique advantage in these kind of things. So this cannot be replicated by the foreign entrants. So in fact, I must also warn you that I've been living in the US and I've seen some brands here. Like there is a brand named Aveda, many of you may know, that is pretty much Ayurveda based, and it is a US brand. So there are such brands emerging here. Similarly, I've seen a European brand, Khadi, which is also taking advantage of Ayurveda. So there is at least there is an opportunity, but we have to be faster. Um, like how is our long-term resiliency framework look like? The first one is agricultural sourcing pivot. We can scale backward integration to transition from petroleum-based surfactants to bio-based derivatives from domestic palm, coconut, and sugar. So last year, when I spoke at the conference in Delhi, to be precise, I think Noida. So I had discussed about how can India become a hub for natural cleaning supplies. So at that point, it was more of a sustainability initiative, but right now it can be an effective economic strategy to move towards bio-based derivatives from domestic palm, sugar, coconut, and so on. So we are not necessarily moving to conserve the environment, which is what we should be doing, but we can do it. We may be doing it for economic reasons because we're not getting enough petroleum-based surfactants. So that is the first thing. Agricultural sourcing can help our farmers also. The second one is China plus one premium. So we should position India as a stable, secure partner, which is what we are trying to do. We should do more. But Vietnam, their supply lines remain very closely linked with China. So, but our supply line, our chemical base is sovereign and domestic, completely sovereign and domestic. This is something I also faced when I was in the government at Niti Aayog. So, a lot of global, particularly US based companies, they came to us saying that we want to completely get out of China. The only way to do that is to come to India, because if you go to Vietnam, Laos, Cambodia, all those ASEAN countries, they have very close links with China. In fact, Chinese suppliers would just move to those countries like Vietnam to continue the supplies without any disruptions. So it's basically the Chinese going into other countries and selling, whereas in India we have a reasonable degree of insulation from China, particularly in our industry. I cannot say the same for many other industries, but in our industry, we are pretty good. So the third aspect is the domestic refining priorities. So we have to prioritize building dedicated domestic chemical refineries while establishing FTAs with the energy-rich nations. So we got an FTA with the UAE to begin with. It was one of the first FTAs in the recent years. And then the second was Australia. So both are energy-rich. Of course, we have many others. EFTA is there. So within EFTA, we have energy-rich countries like Norway. So we have a lot of these energy-rich countries with whom we are, collaborating. So why don't we develop domestic chemical refineries while establishing these FTAs?